Ladies and gentlemen, good day and welcome to Sobha Limited Q2 FY2026 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Saheshwar Ravikar. Thank you, and over to you, Mr. Ravikar.
Good morning, everyone. On behalf of ICICI Securities, I would like to extend warm welcome to all the participants joining the Sobha Limited Q2 FY26 result conference call today. We are pleased to have with us Mr. Jagdish Nangeni, the Managing Director, Mr. Yogesh Bansal, the Chief Financial Officer, representing the management of Sobha Limited. Before we commence with the proceedings, I would like to take this opportunity to wish everyone a very happy Diwali. With that, I would now like to hand over the call to the management for their opening remarks, following which we will move on to the Q&A. Thank you, and over to you, sir.
Good morning, everyone. This is Jagdish from Sobha Limited. Thank you, Saheshwar. We are pleased to connect with you today post declaring our Q2 and H1 26 financial results. We had already shared the details of the operational performance in the first week of October. In continuation of our pursuit to improve our timing of declaring quarterly results, this quarter as well we have done well, thanks to our improved processes across functions enabling this outcome. We delivered a strong and stable performance in Q2 this year, building on momentum already created in the previous quarter in terms of real estate sales, with highly integrated sales and marketing efforts. It also reflects the steady demand on the luxury real estate in a growth economy, with improving macroeconomic parameters and timely government interventions. During the first half of this year, we achieved a real estate sales value of 3,981 crores, which is higher by 30% compared to the last year in the same period. Bangalore has contributed 48%, NCR 38% and 10% from Kerala region of the overall sales. Our total sales for the year were supported by the sale of 1,576 homes, 2.84 million square feet across all operational markets with an average price realization of 14,028 per square feet. In Q2 alone, we have achieved sales of 1,902 crores, consisting of 770 homes, with Bangalore contributing 70% of the sales, despite any new significant project launch. Coming to new project launches, cumulatively in the past 6 quarters, we launched over 10 million square feet in 12 projects. However, the slower first half launches were impacted due to several external and internal issues, and we are making our best efforts to catch up in the second half and launch at least 8 to 9 million square feet for the entire financial year across 7 to 8 projects. We are happy to inform that during current week, we will be launching Sobha Magnus in South Bangalore. Overall, we have a strong residential pipeline of 15.96 million square feet across 13 projects in 9 cities, and commercial pipeline of about 0.74 million square feet across all our operational cities. We envisage to launch these forthcoming projects in the next 4 to 6 quarters. Also, we are working on our subsequent project plans rapidly for about 24 million square feet. And in addition to these launches, our existing inventory at the end of the quarter was about 10 million square feet with a potential sales value of 13,000 crores. Our project delivery teams have also increased the pace of project completions with completions of 2.25 million square feet in the first half of the year. During the quarter, we completed 1.18 million, which is 591 homes. We aim to complete overall at least 5.5 million square feet in this financial year. Improved profitability would reflect as we increase the volume of project completions. In addition to this, our contractual and manufacturing operations are steady with contributing to about 700 crores in terms of revenue in this financial year. With this, I hand over the call to Yogesh, our Chief Financial Officer, to provide details on the financials.
Good morning, everyone, and thank you for joining us today. Wishing everyone warm greetings of the Diwali. I am pleased to share our financial performance for Q2 and H1 for the year 25-26. I will begin with cash flow, covering the quarterly and half-year performance and future visibility, and then briefly touch upon the P&L before opening the floor for the questions. During the quarter, from all businesses, we collected total of 2,046 crores. We crossed the 2,000 crore quarterly collection milestone for the first time, thereby recording a historic high. For H1, we collected rupees 3,824 crore, recording a healthy 30.9% growth over H1 25. Real estate business contributed 90.2% to overall collection, that is 1,846 crore in Q2 and 3,445 crore during H1 period. Contracts and manufacturing businesses contributed 200 crore in Q2 and 380 crore in H1. We generated 513 crore of net operational cash flow in the quarter for the half year, and it was 909 crore, registering a significant growth of 79.1%, allowing us more room for investing in future growth. We spent 632 crore on land-related activity, almost 2x the amount we allocated in H1 25, in line with our commitment to further strengthen future pipeline for growth. Post financial outflow, capex and dividend payout, we generated net cash flow of 63.5 crore during Q2 and 120 crore in H1 26. Company closed the quarter with net cash position of 751 crore, underscoring a very healthy and strong financial footing. Weighted average interest rate has come down during the quarter by 60 basis points. Looking ahead, we have clear visibility of future cash flow expected from our ongoing and forthcoming inventory. From all completed and ongoing projects, we expect total 22,867 crore of future inflow. The cost to complete this project is estimated 13,000 crore, thereby generating marginal cash flow potential of close to 9,800 crore at project level post sales and marketing spend. We should able to realize this over next 4 to 5 years. Additionally, we expect to generate 7,100 crore of marginal cash flow from forthcoming projects of 16.69 million square feet, which shall be launched over next 6 quarters, and the cash flow realized over 5 to 6 year time frame. Overall, we have strong financial footing with robust future cash flow visibility. We are achieving better operational efficiency every quarter, giving us the confidence to pursue further growth opportunity. Now coming to P&L. For the quarter, we recorded total income of 1,469 crore and 2,371 crore for H1 FY26. Real estate income contributed 1,200 crore during Q2 and 1,889 crore for H1 FY26. Contract manufacturing and retail business contributed 209 crore in Q2 and 371 crore in H1. We generated EBITDA of 157 crore in Q2 with margin of 10.7%. For H1, EBITDA was 231 crore with margin of 9.7%. PAT recorded for Q2 72.5 crore with margin of 4.9%. In H1, we recorded 86 crore with a margin of 3.6%. Our total balance revenue to be recognized from already sold unit as on 30th September was close to 18,000 crore. This is Sobha share only. During the quarter, we have received demand for ground rent from Bangalore Authority for OC granted in earlier years. So as a accounting principle, we have made provision of 27 crore in the quarter itself. So once again, thank you for you all for your participation. With this, we can now open the call for questions.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Sukrit D. Patil with Eyesight Fintrade Private Limited. Please go ahead.
Good morning to the Sobha team. I have two questions, one for Mr. Jagdish and one for Mr. Yogesh. So, to Mr. Jagdish, my question is, as you scale in a market that's becoming more price sensitive and competitive, what are the biggest execution challenges you foresee, especially in balancing design quality and delivery timeline and customer experience? How are you preparing the organization to sustain this kind of a differentiation? Yes, sir. Thank you.
Thank you, Sukrit. I think you had one more question for Yogesh, which we'll take once I complete this answer. Well, as you are aware, Sobha has a unique execution model, which is backward integrated, where the entire design, execution, and some parts of the manufacturing are done in-house. This gives us a unique advantage in terms of speed of delivery and also managing the cost of delivery. While that has not been very helpful during the very high inflationary period which we have seen between 2021 to 2024, going forward, if the inflationary pressures continue to be stable like we have seen in the past year or so, then we should have a unique advantage in terms of managing the cost and delivering within time. And as you know, the reliability and the quality of the delivery will clearly put us ahead of the competition when it comes to the customer satisfaction. And that we are continuously focused on, and we are building our teams across functions and mainly the execution teams to make sure that we enable the organization to deliver for the scale that we are preparing for.
Okay, thank you. And my second question to Mr. Yogesh is, with the rising input cost and compliance burdens, how are you planning to protect the margins going forward, especially in terms of procurement, pricing, and project phasing? What financial levers are you emphasizing to maintain profitability without compromising quality? Yes, thank you.
Thank you, Sukrit. So, as you are aware, we are backward integrated company, wherein most of the things we are doing in-house. With this, we have hand on all the cost and procurement. We real-time monitor all the costs. That's if we have to take price escalation because of increase in raw material, we take immediately so that we can protect our margins. That's why we keep track estimation our cost regular basis so that financially we should able to keep our margin intact.
Thank you. Mr. Patil, please rejoin the queue for more questions. A reminder to all the participants, please restrict yourself to 2 questions. Next question comes from the line of Pritesh Seth with Axis Capital. Please go ahead.
Yeah, good morning and thanks for the opportunity. First on the sales performance of this quarter, we saw a good surge in sustenance demand. Just wanted to know what actually worked, especially I guess in the projects like Town Park. What went right for us this quarter to have a healthy contribution, and then how do you see the Gurgaon projects which were launched last year, any sort of action you think you need to take there to have a good velocity on those projects? Yeah, that's my first question.
Thank you, Pritesh. The Q2 sales, like you have observed, the majority of the contribution has come from for 70%, right? And all of them are sustained sales. This shows good on-ground demand for the end-user-based products, and particularly within the ticket sizes of 2 to 3 crores. And Town Park, one of the projects which has that kind of inventory, has done really well. So ticket size definitely helps in terms of the sales, and of course our sustained sales and marketing efforts also has helped. And specifically when it comes to projects like Town Park, where the scale of the project is large, the customers are far more gravitating towards larger projects where the communities are larger, and hence this is a distinct advantage in certain projects like Town Park, and that has created that positive or virtuous cycle of good sales. That's on Bangalore sustained sales. And when coming to your question related to Gurgaon sales, the Gurgaon sales we have like I mentioned earlier, we have made certain changes, and we are seeing reasonable end user demand for our products now. We have made changes in our organization as well, in terms of how in terms of people, and in terms of how we approach the channels that do provide impetus to the sales. And both these seem to be working positively, and we hope to see good results in the second half.
Sure, got it. Just on Town Park, we launched this project I think in March or February this year, and after 6 months we are seeing this good set of demand. That's usually kind of timelines that people are taking now to decide on purchasing a home. Just trying to understand, because at launch we didn't see such good response that we are seeing now. So just trying to understand that this is more of a decision-making time that these the customers are taking right now, or something else which has worked. Yeah.
Well, I would not say that at the launch the response was lower. We did really well even in March when we launched the project. In the first quarter of this financial year, that's where we saw a little bit of hesitation in terms of customer purchase decision making. But since we have multiple ticket size products, and there is timing of ability to time their cash flows in terms of purchase in these large projects, those have really helped us push and accelerate the sales in this specific project. But otherwise, the project start out really well, and it's a very large project. And as we continue to progress during the last 6 months, we continue to release new towers, which has been very, very helpful in making customers taking choices from multiple products that are available.
Thank you.
And one other aspect which we have seen is also in Town Park itself. We had earlier, a few years ago, we had launched Manhattan and Brooklyn, which are parked in the same location, and we have started delivery of our first tower in Manhattan. So delivery confidence also is seen by the customers, and the kind of infrastructure that's getting developed around the whole location also gives a lot of confidence to customers.
Thank you. Mr. Seth, please rejoin the queue for more questions. Next question comes from the line of Biplab Debarma with Antique Stock Broking. Please go ahead.
Good morning, and wish you all a very happy Diwali. So my first question is, you had a very good, strong quarter. Congratulations on that. Although you didn't have any major launches. And in the second half, I understand that you have a significant number of large launches lined up. So if all these launches materialize as planned, looking at the strong absorption in Bangalore and Noida, you have a few launches in Noida. Is it possible we cross 10,000 crore of pre-sales this year?
Thank you for the wishes, Biplab. The launches in the second half seems to be on track, and if the overall momentum continues and some parts of it, if we are able to achieve similar momentum in all the project launches, because these project launches are spread across some of the other cities where launch is not necessarily gives the biggest impetus to sales. There are steady launches in locations like Kerala, in Chennai. So given that, we would stick to still our earlier guidance of about 8,500 crores of what we are doing. If we can do, we aim to do much better than that. If we are able to do it, definitely it will be a positive surprise for all of us.
Okay, sir, that's it. I think, that's good enough. Sir, the second question is, your one project got delayed, launches. Good to hear that your project Magnus is getting launched in third quarter, but it was supposed to get launched in second quarter, but delayed due to approval-related issue. So, sir, how these approvals things are progressing? Do you see any risk of delays that could push some of these launches in this financial to current financial to the next financial year? How is this? How do you see this approval thing? Is there any risk, uncertainty regarding that? Thank you, sir.
Good question, Biplab. Related to specifically the Magnus launch and around some of the aspects of OC that we have faced in the past quarter, the main reason for this was the restructuring of the BBMP, which is now Greater Bangalore Authority, and that restructuring had taken a little bit of time for the actual coming into effect, and which has thankfully come into effect. And now once all the systems are in place for all the 5 corporations to be in operation, then we don't foresee any major reasons for delay. Other than that, we have the rest of the approvals in Bangalore and in the rest of the country. They seem to be on track. As such, there should be no issues.
Thank you. Mr. Deb Burma, please rejoin the queue for more questions. Next question comes on the line of Girish Chaudhary with Avendus Spark. Please go ahead.
Hi, good morning, Jagdish, and performance despite no launches, and also, encouraging to see the cash flow, overall cash flows. And couple of questions. Firstly, on the reported margins, again, we are seeing these to remain low. So how do you think about these numbers, and especially the current project level margins? If you can just give some view on the margins first.
Right. Thank you, Girish. On the reported margins, unfortunately, this quarter specifically, although we could recognize good revenue, there were, like Yogesh has mentioned in his initial comments, we had to take provision for certain charges which are related to BBMP ground rent, which were not earlier recorded because of we had a favorable outcome in the previous, whenever we completed projects. However, since because of new demands that have come in from the authority, we had taken that provision. Otherwise, we could have been slightly better than what we have done. And there are a couple of other small transactions which we have done, which have led to slightly lower higher costs, and which are reflective in the numbers. But otherwise, if you look at the overall big picture in terms of how we are going forward, which is where we have about 18,000 crores of revenue to be recognized from sold units, those margins are extremely protected, and we are, like I have been mentioning in my previous calls, the EBITDA margins in those projects are between 30 to 35%, or we estimate it to be closer to 33 to 34%, and those will start getting reflected in as we complete those projects. That said, in the near term, in the next quarter, also we have several project completions. Like we are increasing the scale of completions, and as those completions come through and some of those good margin projects come through, we should be able to do decent margins in this financial year. From next financial year, as we complete some of the own projects like Neopolis, wherein we have good margins embedded in those projects, so our margins should significantly improve starting from next financial year.
Got it, very clear. Secondly, if you can give us some update on the Hoskote launch. Where are we in terms of the overall approvals, and any thoughts on the phase 1 GDV, so if you can just throw some light on this project.
Yeah. There has been a very good progress on the first phase of Hoskote, which we are aiming to do at more than 5 million square feet, which we have included in the forthcoming projects this time in our quarterly presentation. We are making good progress towards the approvals. The design is completed, and we have applied for the initial plans. So in the next, our current aim is to launch the project in the first quarter of the next financial year.
Thank you. Mr. Chaudhary, please rejoin the queue for more questions. Next question comes from the line of Dhruvesh Sangvi, an individual investor. Please go ahead.
Yeah. Hi, Jagdish. Am I audible? Sorry.
Yes, Dhruvesh.
Yeah.
Please go ahead.
So, thank you. At the industry level, across major parts of India, we see that almost all large real estate developers are in very good shape in terms of balance sheet. And all are now competing for the larger sized complexes because that's the clear trend. In this context, when we look at new business development, we probably as Sobha have engaged, how would you rate Sobha's BD in the last 1 year? And why I'm asking this more specifically is to understand from a competitive landscape perspective that is the cost of acquisition increasing in a market where the sale prices are probably at hitting the roof now? And if you can give some sort of an understanding so that today's land acquisitions will lead to margins 3 or 4 years later, how profitable and how profitable will the growth be in the future? Because growth is coming, but I'm just worried about the 3 years hence profits, because that will be coming from today's decision making.
Right, Dhruvesh. No, good question, which is essentially surrounding BD for these projects. In fact, if the margins or results of those new projects that we are going to do business development today would actually result in some kind of P&L impact probably after 5 years, because you would do BD today and then probably launch the projects in a year or so, and those projects would start getting completed 3 to 4 years hence. So that, the impact for that from a P&L point of view would come much later. But that said, the basic question from your side is whether since BD has become competitive, would we be able to maintain margins? If that's one of the questions, then it's no doubt that the competition has increased for land, and it has significantly made both challenges and also in terms of cost for new land acquisition, in which we think that we are uniquely positioned. because one, we have a clear pipeline of already done BD in the last few years, and hence you can see in our pipeline itself, it's close to about 25 plus 15, close to 40 million square feet, which is clearly out there, and hence the ability to do BD now is more of actually 2 to 3 things. First is on our ability to be patient and actually do deals which fall in alignment with what we set out to in terms of financial objectives. That's number one. Number two is our own capital structure has become better, and hence some of the land parcels that we can really pursue would reduce the. I mean, we would do it in a reduced competitive environment. Second, third is we are being a little bit strategic in terms of the locations as well, as you have seen in the last one and a half years. When you're asking if how do we reflect on the on our BD. So certain locations we have chosen where there has been a demand-supply gap, and those like Greater Noida, what we have seen, where we could quickly turn around, although invested, there is a outright and direct investment, we could convert it into a project and launch it and actually enable the monetization of the asset in the quickest possible manner. So similarly, we are doing some of the other transactions wherein speed is very helpful. If not, we are getting much higher margins. So it's a combination of many. And second, in addition to what we are doing, pursuing in new geographies, in existing geographies like Bangalore, what we have been doing is, again, we are pursuing opportunities of much more in consolidation and in locations where we are already comfortable with, and where we get opportunities based on our track record, our presence, and our relationships. And that has really helped us in procuring new opportunities in existing geographies.
Thank you. And just one more part on pricing. How do you see pricing overall in Bangalore particularly? And second, what about the entry in Mumbai? I mean, is the Mumbai launch a part of the second half that you are talking?
Yes, absolutely. The Mumbai launch is indeed in the plans for second half. We have we have made significant progress in terms of approvals. So we are hoping to do the first phase of the launch very soon. And secondly, when it comes to the pricing specifically in Bangalore, I think we have seen good price increases in Bangalore for the last couple of years, 3 years. There has been a continuous rise, mainly due to the demand supply again, and end user demand has pushed up the prices, whereas the supply has been reasonably stable. So we are entering into a phase of a steady demand and supply in Bangalore, and probably in some aspects the supply might increase, and if that does, then from a pricing point of view, we should see a stable or inflationary increase in the pricing than the kind of price rises we have seen in the last 4 years.
Thank you. Mr. Sanghvi, please rejoin the queue for more questions. Next question comes from the line of Abhinav Sinha with Jefferies. Please go ahead.
Hello.
Good morning, Abhinav.
Hey, hi. Sir, can you hear me?
Yes, absolutely. Please go ahead.
Okay. Jagdish, good to see the uptake in numbers. Just 2 questions. So firstly, on the pipeline for the next 6 months, is there any NCR project that you are launching, or this is skewed in favor of Bangalore?
There are the 3 projects that we envisage to launch in NCR. One small service department kind of project in Gurgaon, and one phase of a residential project in Gurgaon. And third is there is a project that we plan to launch in Greater Noida. These three projects are also part of this. All these three put together, it would be about roughly about 3.5 million square feet.
Okay, and this is all coming in the second half of the year, right?
Yes.
Okay, great. Just the second question is a little more on the industry and what I see in the last 4 years in your own numbers as well. So basically, we hear a lot of data from the industry that volumes are now flat for a couple of years. And I think in Sobha also, we have been selling the same 5.5-6 million square feet range, and this should be the fourth year of that. So do you think, again, both the industry and your own volumes have picked out? So it might be that value sales are higher, but volumes is as good as it gets?
Well, it's directly a function of new launches, Abhinav. And as we increase those and increase the diversity or geographical diversity of those, then the number should become much better. That said, the majority value increase has come even for us specifically through price increase because of change in the mix of the new launches and sales of new projects where the pricing is better than the earlier ones, right? So it's done. So for the next leg of the growth for us, it will be more led to by having new project launches and probably lesser by the further increase in pricing.
Thank you. Mr. Sinha, please rejoin the queue for more questions. Next question comes from the line of Gaurav Khandelwal with JP Morgan. Please go ahead.
Yeah, hi, good morning. Happy Diwali. Thanks for taking my questions. I have a question which is more generic on the industry norms rather than Sobha's operations in itself. Because you are pioneers of the business that you do, which are some of the micro markets that you operate in where you're seeing concerns around growth, and is that growth concern a function of purely price increases in the housing sector, or is it something else which is driving that concerns around growth? So any color on this would be really appreciated. Thank you.
Thank you, Gaurav. Well, as you know, we are operating in 14 cities and as of now, and our prime growth driver markets, specifically in the past 2 to 3 years, have been our mothership, which is Bangalore. And Bangalore itself has several micro markets. And even in the micro markets that we are operating in, we have predominant presence in southeast and east. That continues to do well. While these are doing well in Bangalore, the North Bangalore is also picking up really well because of the capacity constraints that we are seeing in the rest of the micro markets. So hence there is from a micro market perspective in Bangalore itself, broadly this is how we look at it, and we are looking at opportunities, and we look forward to launching projects in all of these to capture the sustained demand in Bangalore. And in addition to Bangalore, we have a good presence in NCR. NCR, while there is Gurgaon with its good infrastructure, or at least from a accessibility point of view in the last few years, and there we have diversified our own presence in terms of micro markets. Earlier we were present only in Dwarka Expressway. Now we are present in several other sectors in Gurgaon. So that has helped us sort of de-risk our scale there. And third, in addition to that, we have also moved to Greater Noida, which is also a very good growth market. Specifically in the last 2 years, we have seen good demand and due to the fundamental drivers there. And hence, that is also a geography that we would like to continue to focus upon. While these are two big growth drivers, we have been very steady in Kerala, and we have Kerala, 4 cities are doing well, and they are largely it's NRI demand, which is quite steady even in the last few years, and hence however, there are challenges in Kerala in terms of both execution and the cost related to it, and hence we would like to keep as a steady market rather than a huge growth market. While these are the main 3 geographies that concentrated geographies we have operated in, there are a couple of other one geography which we have just started, which is what I have mentioned previously, is Mumbai. We are hopefully going to start our first launch in this next half, and that's a very large geography, and for a luxury housing demand perspective, it has one of the biggest shares in India. And by being present there, and it's a long-term focus for us, which is we are currently taking small steps, and as we progress there, based on how the demand is panning out, we would definitely continue to invest in that region also. And we have other cities like Chennai, Hyderabad, Pune, and GIFT City. These are smaller markets, and this is where we would get opportunities, and we would invest in opportunistic manner and not necessarily with any strategic focus.
That's very good, color, sir. Thank you so much. Those were all my questions.
Thank you, Gaurav.
Thank you. Next question comes from the line of Himanshu with Steadfort LLP. Please go ahead.
Yeah, hi. Good morning. My question was on the margins itself. If you look at the first half, the revenues on the real estate have increased by more than 50%. Okay. But if I remove the other income from EBITDA, we are very nearly flattish. Okay. So what happened in that 22-23 phase in the projects what we sold, where the margins went so low? Because that was one of the periods where everybody was increasing their prices on the projects what they were selling. And what gives us so confidence that those problems will not reoccur, or things will not go that wrong in future, just from the learning perspective in the organization? So slightly, some thoughts of yours will be helpful on.
Sure, Himanshu. No, good, relevant question, because margins is indeed a concern even for us, and it's been our focus right from the beginning. And this was, like I was mentioning before, this was a one-off period where we were operating in very high inflationary environment. That said, that is one. Second is, while and majority of these revenues that we are recognizing now, while the prices was rising in 21-22, the costs also significantly increased, and that's a reflective of what we are seeing in terms of margins. I don't think that issue would recur if we are able to increase our scale of our construction and timely delivery. While there was, unlike several of the other real estate players, as you know, we are backward integrated. And during that time, one of the biggest challenges is not only of cost increases, but also supply chain disruptions. And due to that, there have been certain delays in the project. And because of that, our fixed costs also have come into our overall project cost. And hence, that's really dampened our margins. And going forward, if we do not encounter any such black swan kind of events, then there should be no reason for us to continue to deliver the kind of margins that we have envisaged. because timely delivery and ability to manage the cost in terms of chain. If these two are done well, then we are fairly confident of delivering the projects. So most important for us is to focus on the timely completions of the projects, and that's where our current extreme focus is.
Okay, and one small thing. On the commercial side, we have 3-4 projects. One is ongoing and rest are forthcoming, but the forthcoming have been there for quite some time, okay? And for nearly 2 years, they have been in the forthcoming list. So what is the thought process? Are we back to the drawing board, rethinking of those projects we want to do or not? Or there is some, let's say, approvals which are pending, or what is the, because now we have cash, if we are really interested, we can go with those projects. But, the forthcoming on the commercial side remains forthcoming for quite some time now.
Right. One of the biggest forthcoming project is a commercial in Gurgaon. The reason for us to take time for us to launch the project has been change in our approach, because earlier this is a land which we own entirely, and we wanted to take advantage. Although initially we planned to launch it with the current FAR that's available, then considering the cost of the land price increases in Gurgaon, we have changed our approach and we have loaded TDR onto the same land, and hence we had to do both purchase of TDR, redesign, and hence now we are nearly complete in terms of both those activities, and hence we can launch. But otherwise, apart from this, I have not seen any major delay in the commercial projects.
Thank you. Mr. Himanshu, please rejoin the queue for more questions. Next question comes from the line of Parvez Qazi with Nuvama Group. Please go ahead.
Hi, good morning and happy Diwali to the entire team. 2 questions from my side. First, over the last 4 or 5 years, the industry clearly has seen the benefits of premiumization. Our own, sales in terms of ticket size, the data that we see, has clearly seen a move towards higher ticket items till FY25. Now, in the first half of FY26 and especially in Q2, we again saw very good contribution from the up to 2 crore or 2 to 3 crore ticket sizes. Now, I know one should not really focus too much on 1 quarter or half, but do you think now probably we have reached a point where the mid-income segment will probably claw back some of the share that it has lost, or do you think the premiumization trend is inevitable largely because the prices have increased so much over the last couple of years? That's the first question. And second, would be great to hear your thoughts on demand in some of the major markets that we operate, especially with regards to the upcoming festive season. Thank you.
Thank you for the wishes, Parvez. Coming to premiumization and the impact, actually we have to look at probably 2 different aspects. One is the pricing premiumization, and second is the actual ticket size, right? Indeed, there was a big demand for larger homes as we saw it in COVID and lately after COVID, and the affordability at that particular time for the pricing and for that ticket size was very good. So it's not only that it was there was a requirement for a larger home, but the ability to afford that larger home, given that at that point of time pricing was both were in line, and hence we could see a good surge in the demand towards that. But as the pricing has continued to increase, then certainly the budget and the ticket size the aspect of these two will start kicking in, and that's very clear that now again the ticket size constraint is a big factor in how we mix our projects, and also that's one in terms of when it comes to to certain geographies or certain micro markets, and it is entirely dependent also on the micro markets where we launch the projects, right? So, but from a large volume point of view, you are right that it is largely, again, we are going back to drawing board and rethinking about some of the aspects which is with focus on ticket sizes. And affordability clearly matters, but that doesn't mean that premiumization is going to vanish because customers are preferring higher quality products and not necessarily going for I would not term it as affordable housing yet. And our own ability and the cost, irrespective whether it is a luxury project or a affordable project, largely remain the same because the cost of land is roughly similar, and our cost of delivery is there is very little difference between a high-end luxury project versus an affordable housing, given our quality emphasis on every product that we deliver. So hence, we would continue to focus on luxury products, probably, but maintaining within the ticket size. That's where the demand funnel is the largest. That's one. Second is with respect to the overall pricing and the trend that we are seeing. Again, the pricing is if I compare like to like in terms of the same project, what we have seen in the 6 months or 6 to 12 months, the pricing, we have taken small price increases. However, that seems to be the increase in the pricing is not at the same pace as what we have seen in the past. That's very clear in the market, not just with us, but across several players. So hence, my view is that given the demand and supply, again, depending on the extreme micro market dynamics, is largely there is steadiness on both sides, and hence there should be from a pricing point of view, only the increases in the pricing would be far more inflationary rather than cause of demand supply mismatches.
Sure, sir. Thank you.
Thank you, Parvez.
Thank you. Next question comes from the line of Parikshit Kandpal with HDFC. Please go ahead.
Hi, Jagdish. Congratulations on a decent quarter. So I have two questions. One is that to total business development done across the city. So you are going to a launch heavy season. So just want to understand how are you replenishing land in NCR, Gurgaon, Noida, Bombay, and Bangalore. And second question is when you spoke about margins and this, you said that next year could be seeing a substantial jump in margins. So in light of that, I think which quarter, I'm not asking you which margins will improve from which quarter, but decisively in this year, I mean, is it third or fourth quarter where you will see the new launches, the contribution into revenues substantially increasing and older projects getting phased out? And in light of that also, if you can quantify what was the ground rent which was taken, you have taken hit in this quarter. Thank you.
Yes, thank you, Parikshit. From a business development point of view, we are active in growth markets, both in Mumbai, in NCR, and in Bangalore. We are continuing to do our under the radar consolidation and also any specific opportunities that we get due to our existing whether relationships or presence within in a certain micro markets. So replenishing the current inventory that we have is a continuous process. In Bangalore, we are quite confident of since there is enough pipeline of new launches which is spread for the next few quarters. We are quite and there is enough visibility in terms of future through the land banks. So we are quite confident of maintaining that inventory levels in Bangalore. However, in the NCR market, it's a very dynamic market, and we are very active trying to look for new opportunities. And we have been successful in the past 6 to 9 months. And I think going forward also, our engine is quite active. And coming to Mumbai, we are actively looking at various opportunities. It's a continuous process. So from a business development point of view also, we are quite active overall. And as we make progress and our cash flow becomes even better and our own success in some of the markets become more clear, we would be far more active in some of these locations.
Jagdish, I was looking more for a number like in this financial year to date, how much business development you would have done, because you don't disclose those numbers separately like other companies. So just wanted to get a sense on those numbers, how much GDP addition has happened, and across the markets, if you can give a split.
Yes, we do not, as you know, as a choice, we have not been disclosing the new business development numbers. Once we get comfortable to disclose those, we would do that subsequently, Parikshit. And coming to the ground rent matter, which we have taken a provision of 27 crores in this quarter.
Thank you. Mr. Concall, please rejoin the queue for more questions. Next question comes from the line of Vipul Kumar Anupchand Shah with Sumangal Investments. Please go ahead.
Hi, thanks for the opportunity. My question relates to margin. So, one of your Bombay-based peers just released their numbers, and their operating margin is 60%. And so when I compare your margin, so your margins are very low. And since we are backward integrated, I fail to understand why our margins are so low.
Thank you, Mr. Vipul. Like we have been mentioning in our earlier calls and even this call, the majority of the revenue that we are recognizing in this quarter and probably past quarters have been largely joint development projects where the cost increases have impacted in both ways, both for our construction costs and also land cost, because land cost is part of the joint development cost. And that's one. Second is also our method of accounting is a little different from some of the Bombay-based developers' accounting. Ours is on completion, whereas some of the other peers that we see in geographies like Bombay, it is more to do with percentage completion. So there is an accounting difference also. Both these would reflect the difference in the numbers.
So, sir, you mean to say you recognize when the project is fully completed?
Absolutely. We recognize revenue once the project is completed and once we hand over the units to the customers.
Okay.
So hence this is reflective of the sales and embedded margins that we have done in probably in 2020, 2021 and 2022, and not of the sales that we have done and the embedded margins that we are reflecting today.
Thank you. Mr. Shah, please rejoin the queue for more questions. Next question comes from the line of Pritesh Seth with Axis Capital. Please go ahead.
Yeah, thanks for the question. Thanks for the opportunity again. Again, a continuation on business development. So I think we have already spent 1,700 crores worth of capital raised through rights issue. Yet we have a positive cash balance sheet, net cash balance sheet, I would say. Does it make sense for us to be a little more aggressive on business development versus what we have been doing since last 3-4 quarters? And what would be our target markets specifically? Bangalore, we do have pipeline. Does it make more sense to then focus on NCR, Mumbai, which is our new markets where we are looking to strategically scale up our business? Yeah, that's my question.
Absolutely, Pritesh. That's one of the reasons for us to raise capital, and that gives us enough leverage for us to do increased business development in future. But that said, as you already also know, that the new business development is coming at a much higher cost, and we would like to look at margin of safety as well. And given that we need to balance both, we are building a healthy pipeline of new BD. And from a geographic standpoint, it is both in NCR, Mumbai, Bangalore, all these three, and a little bit of Hyderabad. All these four geographic markets are we are continuing to build up a pipeline, and we are making significant progress in all these. So, which one would start seeing it in the coming future.
Sure. And just a second and the last one, on the forthcoming pipeline, I see some changes in Gurgaon pipeline. We had earlier 3 projects, now it shows only 1. I think some of them have slipped over to subsequent launches. Is it just a rethinking of a product and we'll probably launch in 2 years from now, or how, like, why these changes have come?
The main reason is we have looked at the product mix, and we wanted to make some changes in the product mix, and that's why some of them we have moved to subsequent projects. And as we again put back with the complete design and we start the approval process, we will put them back in the forthcoming.
Thank you. Mr. Seth, please rejoin the queue for more questions. Next question comes from the line of Pankaj Bobade with Affluent Assets. Please go ahead.
Thanks for taking my question, and happy Diwali to all. So, I would like to ask, I have a couple of questions. First is, you have, in your 4th October's press release, you have mentioned that our quarterly sales value was 1903 billion, that is 1903 crores, out of which Sobha share was 1537 crore. Whereas in this quarter, when we reported, the number is 1407. So just wanted to understand what is the discrepancy, what is the reason for this difference. Secondly, in your quarter 1 Concall, you had mentioned that you would be growing at around 30% this year, that is in FY26, and over FY25, that is around 4,000 odd crores of top line. And in FY27, you will be reaching around sales in the region of 10,000 odd crores. But in answer to your previous participant, you mentioned that you will be reaching around 8,000 plus crores in this year itself. So wanted to understand what is the which of this is should we consider, and it would be better if you answer these questions first.
Thank you, Pankaj. First, I'll take the second question first, which is last year we did about little over 6,000 crores, and 8,000 is roughly about 33% over that, and that's what we are aiming at. So largely it's consistent with what we have been doing earlier, which is essentially growth over the last year and the previous year, which is roughly about 6,400 crores. So hence, largely the numbers that we are talking about is in terms of percentage growth are similar. And second, coming to your specific question related to the Sobha share, not very clear on your question related to the Sobha share, but if our investor relations can reach out to you and clear that number, that would be better.
Sure. And sir, my final question is the worst behind us as far as legacy project is concerned, given the margins which have been tapering, which have dropped out now? And do we see going forward our margins reaching our previous highs?
Yeah, absolutely. We are very confident of that, and as you know, it's a reflection of, because in real estate we already know what's the revenue that's going to be recognized, and we do have 18,000 crores of unrecognized revenue from the sales that we have already done. and we know what the costs associated with those are, and we are reasonably confident of delivering within those costs. And once those cost parameters are met, and once we start delivering these projects, we should start hitting much higher margins in subsequently. See, the timing of that project level margins are dependent on the project completions, and as we gather pace in terms of project completions this year, and specifically from next year, some of the higher margin projects completions come in, the mix would definitely move towards the higher project margins, and hence that will be reflected in the overall P&L.
So what can be the tentative margins for FY26 and 27 on operating level, EBITDA margins?
I mean, I would not like to get into exact number at this stage.
It would be fine if you give a range, 20s, 30s.
I mean, our project level currently we are at about over 20% on the gross margins, and that we should be able to increase it, move towards 30%. Subsequently, which is probably next year we should move towards that. We have not yet estimated what exactly would be that. We can do that, and we'll be able to clearly state it out or have a view of that towards the end of this year.
Thank you. On behalf of Sobha Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.